In this video, guys, we'll be talking about Vestas Wind Systems. We'll be analyzing the stock and I'll be telling you a little bit about my thoughts on it. There's both ups and downs, definitely that is for sure. And I'll also be talking about how this company could actually really have a big future and get into some even bigger markets and fields. And we all know that the clean energy, renewable energy sector is going to grow in the future. That is expected. So that is not really a surprise, but I'm actually going to show you something that might surprise you about the company's scalability. So let's just get right into it with simply Wall Street right here, and take a look at some ratios, some valuations, and future growth forecasts from some analysts. Actually, 21 analysts have made these estimates, so should be pretty reliable. But yeah. First of all, let's talk about Vestas. So here we are. First of all, let's talk about Vestas as a business, and well, especially the share price is something that you will notice is very volatile. It's not a stable stock. It is a growth stock, and it moves up and down a lot. So that's just something that you will have to live with if you're buying this company. You can be up 5% in a week, or 6% in a week, and down. That is kind of where it lies. 6% up and down every week. That is the price change. No, 5% a week. So it is it's pretty volatile, and that is just something to keep in mind when buying the stock. For the valuation. Oh, geez. For the valuation right here, yeah, it's definitely not a cheap stock, but you know there's a lot of expectations for this, and I definitely think that it's not fair to put this in the European electrical industry, compare that to that, because you know it has a PE ratio of 36.8 right here, and you know that is high. You can say that's high if it's above 30, but you know it is a sector that usually has a higher PE ratio, which is a price to earnings ratio. That means basically what they make in terms what they make in comparison to their share price, which basically it would take 36 years for them to for their earnings per share to kind of cover the whole cost of the price. So yeah, that's a lot of times. So it is a pretty expensive stock, but there's a lot of expectations for the sector, so it's kind of normal. And the electrical European electrical industry is lower, but we should actually more compare it to like the renewable electrical industry, because that industry would be higher in average, I think. So yeah, P ratio is a little bit to the high side. But yeah, that is that. The price to growth ratio is also 2.3, which is well above what we would like to see it at. But yeah, that's just how it is. You kind of probably are used to these high ratios if you are working with renewable stocks normally. So future growth, they are actually forecasting a 16% annual earnings growth with it, which is very significant for a company this size. It is the world's largest wind turbine manufacturer, and so 16% annual earnings growth, very good, and we'll also see the past performance in a moment. So yeah, they just expect the revenue to keep bumping up here, and the earnings as well. 16% annual earnings growth, that is great. Okay, guys, that is really significant, and you might be used to seeing companies with like 50% annual earnings growth, but you know that is not realistic. This is a growth company, and they usually have higher. But if you look at a company like Intel, or a huge company like a tech company like that, they grow their earnings with 1-2% a year, and that is great. If they like go 5% in a year, that's just insane and blows everyone away. So you always hear about these crazy growth numbers, but this is really great for a company this size. So let's scroll down here to the past performance. They have had a historical -9% earnings growth, and yeah, you'll have to look into why that has happened. That is probably something with the news of the company. I won't go into that today, but really understand all of these things, because there's always a reason behind the things that are happening. But again, mostly look forward, because that is really where it matters the most. They have a high quality earnings, and their net current profit margin are higher than last year's profit margin. 6% is not a high profit margin, but it is definitely much higher than the 3.6 last year. So they're growing their profit margin. That is really one of the most important things in a company like this. So yeah, they're accelerating growth. They exceeded, oh my god, what is this? Earnings growth of 72% in the 72% in 1 year. Come on, guys. That is probably what you normally hear about on the news and stuff like that. Companies doing that amount of growth, but really 16% is a crazy amount of expected growth. But I think it's definitely achievable by this company. So the financial position is, I definitely have seen it better than this. A couple of years ago, when I looked at the stock, it was looking a bit better. That said, the valuation was all out of, it was bad at that time. But the financial health, short term, we're not that great, to be honest. You can see the short term assets do not cover the liabilities. Yeah, but that is just how it is. Long term is probably more important, and it actually covers it 3 times the assets. So long term we're pretty good, but short term they have a lot of liabilities. And you see that the revenue have grown significantly here over the past year here with the thing that has been going on, and the debt has also grown. The debt to equity ratio has increased, which means that these 2 lines here gets closer to each other. And that is not great, but still, the debt to equity ratio, although it is increasing, it's still low. So that is really important. And balance sheet, great. Dividends, it's not a dividend stock, that's for sure, and I don't really mind that. I say this in pretty much every video. I like, I buy, if I want to get dividends, I buy a dividend stock. If I just want growth in my investment, then I don't go for dividends at all. So this is kind of a growth investment, and not definitely not a dividend stock, with a 0.66% dividend yield, and it has been pretty volatile. The dividends payouts have been, you can see, both in percentage and price per percentage dividend per share. It has been volatile because the share price is also so volatile. So that's really something to consider. If you want to buy this stock for dividends, then get out of that, because that's not worth it. The management team is really important, and the management team is not considered experienced, with only 1.6 years of average tenure. Not great. I really like when a company has a great experienced management team. That is so important, and I really appreciate when they have that. But this company, it's not experienced, very experienced. That said, they can be great still. Maybe they just have switched out, but no insider trading has been going on, which is probably a good sign. No shares sold. I would have liked to see some bought shares, but whatever, right? Mostly it's these big names: the BlackRock, Vanguard Bank, Swedish Bank, Norway's Bank, Danish Bank right there, and all these big names are buying these stocks to kind of be more sustainable. They want to get into this, which is the future. So there's a lot of big dogs holding the stock, and there's not a lot of public private people up here. Actually no one is up there in the high ownership. percent wise. So what was I talking about before, guys? What was I talking about with why this company could potentially really expand much beyond everything imaginable? Well, it's because of this right here. This is a list of the list of largest companies by revenue. 2021, you can see here the largest one is Walmart, and then we have State Grid, Amazon. But you see, look at the industries right here: oil, gas, oil, gas, oil, gas. Scroll down: oil, gas, oil, gas, oil, gas. Scroll down, and then it thins out a little bit. But you know, that is what it is: 6, 7, 8 oil and gas stocks in like the top 20 biggest companies in the world. That is crazy, and that has to be switched. You can see the revenue each year down revenue, down revenue, down revenue, and down revenue. None of the oil and gas stocks are up in revenue. What did that suggest? Well, it suggests that in the future, a company like Vestas Wind Systems could be laying here at one of these places right here, and that is really, you know, when these oil and gas companies step down, who has to take over? It's Vestas, it's Plug Power, it's these Enphase, it's these companies that make solar and wind power, mostly wind power. That is really the most easy to make and use and everything. But we need it all. We need hydrogen. We need everything. So yeah, I there's so much potential, right? There's so much potential in Denmark, where Vestas Wind Systems are founded, and yeah, we are kind of very far along in the renewable energy. We have a lot of renewable energy. We actually on a good windy day, we produce 150% of our energy usage. So that means that we can export to Norway, and then we get what is that? Water power. I don't know what that is called. From their lakes and stuff like that, exported down here when it isn't windy. So that is kind of the whole system. So also in America, you know, they have like, I think it's 12% of the power is renewable, and in Denmark we have like 36% or something. So there's a lot of room to grow. That's what I'm trying to point out. So I actually don't think that this valuation, I actually would be surprised if it was higher than this. So I'm actually very glad. I actually sold out of my Vestas position at a peak here. What is that? 2 months ago. Pretty lucky. I sold out right at a peak, and then it just went down, and now it's up again at the same level. So I'm actually looking to buy the company again. I don't know when, but when I look at this, when I analyze the stock with you guys right now, I actually get kind of into this stock. So you can see they have a price target, analyst 1 year price target of almost 500 Danish crowns, and that's a double from where it is laying at right now. The statistics, you have a P ratio of 37, and forward P ratio is not there. Price to sales 18, that is high, but you know, expected from this company. Profit margin right there again. Yeah, what can we see? Yeah, they're growing their, you know, the pandemic has been a problem for definitely a problem. Yeah, there's not much more to say about the company, and I don't just want to stagnate in my sentences. So I just want to pretty much end it here. Vestas Wind System, great company. You definitely want to look more into it and watch my other videos on the company. Yeah, they have qualities, and they have definitely also have their downsides. But just because there's one bad thing to say about a company, there's always a bad thing to say about a company. I'm just going to switch out here so you can see me nice and wide. there's always downsides to a company, and that doesn't mean that it's a bad investment. So you have to look at it with your own eyes, and I definitely think and hope that this review analysts and can help you understand the business and understand what is going on, and if it's an investment that you want to make. So yeah, I definitely think go and look beyond the American market when looking at renewable energy stocks. That is what I can recommend for you. Try and look in the northern countries. We're really far along with these things. So look at Finland and Norway, Sweden, and Germany also, and Denmark. Look at those companies and try to find some stocks similar to this one if you're interested. Yeah, that's pretty much it for this video. I really hope you enjoyed the video, and I hope you will like and subscribe. And with that said, have a great rest of your day. Peace out. Whoop.